Thank you all for being here. Let's pick up on this issue. Republicans have suggested that the changes in the law to prevent another 2008 crash have undermined market liquidity, and I just want to dig into what that really means. Mr. Weiss, you wrote an op-ed in the Wall Street Journal last year in which you noted that while there may have been more liquidity before the crisis than there is now, quote, pre-crisis liquidity built on excessive leverage and unstable funding turned out to be available in good times, but not in bad. During the crisis, those inventories did little to prevent the financial markets or the broader economy from freezing up. And I think that's consistent with the testimony that you have offered today. I think this is a very interesting point, and what I want to ask is whether you think that because of the new rules, including Dodd-Frank, there is now a better chance that liquidity will be available the next time there's panic in the markets.
Senator, that is really at the heart of the question, and it is absolutely the case that pre-crisis liquidity, for reasons that we've all stated, is a poor benchmark for overall liquidity. And it is our judgment that however one wants to characterize liquidity conditions today, and again, I think Governor Powell and I have given generally a sense that liquidity is sufficient in fixed income markets, although there are those who argue to the contrary, but the evidence again suggests it's within normal ranges. I do think that what regulation has produced is a higher likelihood that the liquidity conditions that exist today will be available tomorrow in a period of stress.
So let me just underline that point and make sure we're exactly on the same page. I don't want there to be any ambiguity about this. Do you think that Dodd-Frank and the ancillary rules have made financial markets more resilient and better equipped to handle the kind of stress we saw in 2008?
Without a doubt.
Thank you. You know, I think some of this discussion of liquidity may miss the forest for the trees. Liquidity that disappears exactly when the market needs it is not very valuable. Our focus should be on ensuring liquidity during times of stress, and it sounds like Dodd-Frank has helped us do exactly that. Now, while we're on the subject of liquidity, Governor Powell, I wanted to ask you about the Fed's recently finalized rule on the liquidity coverage ratio, and I think Senator Warner may have started this while I was gone. As you know, the liquidity coverage ratio is a joint requirement of the Fed, the OCC, and the FDIC. It currently applies only to a small group of the largest financial institutions, largest banks in the country, and it requires those banks to hold a certain amount of highly liquid assets. The idea is that the biggest banks should have a minimum amount of liquidity so they can weather a crisis without needing a bailout. How much credit a bank gets for an asset depends on the asset's liquidity. So, for example, cash and treasuries are considered level 1 assets, and they are given the most credit. Fannie Mae and Freddie Mac securities are considered level 2A assets and given less credit than level 1 assets. And then certain highly liquid and marketable corporate debt securities are considered level 2B assets and given less credit than level 2A assets. Originally, municipal debt was not given any credit at all. Now, the Fed recently changed this rule to allow certain highly liquid and readily marketable municipal securities debt to count as level 2B assets. The Fed determined, however, that municipal securities were not liquid enough to count as level 2A assets. So my question is, can you explain why the Fed was more comfortable counting certain municipal debt securities as level 2B assets rather than level 2A assets?
Yes, Senator. Well, I think you accurately stated the point. The level 1 assets are highly liquid, highly reliably turned into cash in moments of stress when they're needed to do so. Level 2B is the middle ground, and it tends to be the GSEs in our market. And level 2B is... You meant 2A. Sorry, 2A. Level 2A is the GSEs effectively, and level 2B is corporates, highly rated corporates that have good liquidity. And it seemed to us, and it seemed to me in particular as well, that investment-grade munis that are general obligation bonds were more akin in their liquidity. If you look at their actual liquidity trading statistics, they were more akin to highly rated corporate bonds than they were to, the sub-sovereigns, which trade almost like treasuries.
Okay. Would you have concerns about liquidity in a time of crisis if municipal debt securities were counted as 2A level assets instead of 2B level assets?
I think that would give them too much credit. We have to make a judgment here. I think they're in their liquidity characteristics, they're much more like corporate bonds. We really want these large institutions to have highly liquid assets, and I don't think that munis qualify to be 2A.
Okay, so these characterizations are what really go to the heart of the liquidity issues that we're dealing with now, and making sure that the liquidity is there when we really need it, which is also what we're trying to accomplish here. It's critically important that our biggest banks have sufficient assets in a time of crisis and that those assets be liquid. But it's also important that municipal bonds are treated fairly under the new rules. And I appreciate your perspective on how we try to get that balance. Thank you. Thank you, Mr. Chairman.